Good evening, ladies and gentlemen. I am Ashish Shankar, and I lead the private wealth practice at Motilal Oswal, and I shall be your host today evening. It is indeed my honor to welcome all of you to the most anticipated capital market event of the year, the 29th Motilal Oswal Wealth Creation Study. On behalf of the entire Motilal Oswal Group, I extend my heartfelt gratitude for your presence here today, both in person as well as virtually. I mean, this event is being live streamed on YouTube as we speak. So the wealth creation study has been an integral part of Motilal Oswal's commitment to research and thought leadership. Each year, this study by Mr. Raamdeo Agrawal offers a unique lens into the dynamic capital markets in India and comes up with actionable insights. In fact, over the years, these studies have helped evolve the QGLP framework and philosophy which is being practiced at our asset management business across all the products. The theme for this year is extremely relevant. It's called Creating Wealth Through Bruised Blue Chips, right? And I'm sure many of you think that blue chips currently or today are bruised. I mean, the mid caps and small caps have been flying. So this study should offer an interesting perspective as to how to create wealth through blue chips. It explores how undervalued yet resilient blue chip companies, when identified with research, offer unparalleled opportunities to wealth creation. In fact, it resonates with the fundamental principle of value investing, identifying quality at a bargain. The study, as most of you who have attended the other studies know, that there are two parts to the study. The first part is a statistical part, which covers the period between 2019 and 2024. It basically shows you which have been the fastest, biggest wealth creators over the last 5 years, and it also shares which are the most consistent wealth creators. So to present this study, without any further ado, I invite on stage Mr. Raamdeo Agrawal, Chairman and co-founder of Motilal Oswal Financial Services, who's a visionary in equity research and investing, has more than 4 decades of experience, and somebody who everybody in the capital market world looks forward to when he speaks. So, Raamdeo ji, over to you. Big round of applause, please.
Good evening, friends, and it's a pleasure to be coming back and talking about 29th Wealth Creation Study. So this is started in 96 when the company became corporate. So to felicitate the corporatization of the company, we came out with this study, and since then we have been keeping the tradition on, and this is 29th year. In fact, to me also it's amazing that if a non-stop 29 years. So this has been a fantastic journey, and now it is a way for me to learn in the stock market. So this study particularly is a framework. It's a how to think about particular type of companies, and it is the biggest education to me, as well as I'm sure it is a way of thinking with a lot of people, those particularly in this kind of growth mania market. They don't look at, I mean, it just gets blindsided, but the big opportunities are thrown there, and very serious amount of wealth has been created by the practitioners of this particular strategy, and it will come out in, I think, panel discussion even more clearly, because I am not a practitioner of this strategy, but there will be panelists like Amit Goyala and all, those who practice this, Rakesh Jhunjhunwala and all, he will be able to talk a lot more about this particular strategy. So this we call it Creating Wealth Through Bruised Blue Chips. So it has 3 parts of the presentation. First is wealth creation finding. In last 5 years, what has happened, how the market has, what are the winners, losers, and the pace of wealth creation, pace of wealth destruction. And then second is the thematic, bruised blue chips. And third is the current market outlook, which would be of interest to everybody. So let's start with the study findings. So concept of wealth creation, for the people who are coming for the first time, the process by which a company enhances market value of the capital entrusted to it by its shareholders. So this is the biggest game in town. Worldwide, I think all the corporates, in fact, all the wealthy guys all over the world, they are made up of the market caps. And it is about 120 trillion dollar game, US being 62 and a half, 63 trillion dollars. So, but this wealth has been created by some amount of money given by people to the managements, and they have enhanced the value. So clearly, this is the biggest game in town, and hence it is worthwhile to study how this wealth has been created by people at large. Net wealth created in last 5 years is calculated taking the 5 years gap in the market cap of top 100 companies and adjusted for the whatever corporate actions the companies have done in terms of raising money or equity dilutions. These 100 companies, top 100 companies we have picked up, they have created wealth at the rate of 26% compounded for the last 5 years, whereas the market has done about 14%. So clearly, if you see all the past studies, every time this set of 100 companies, they create at least 10 to 12% higher wealth than the market itself. And this gives that extra opportunity for the active managers to create wealth for the shareholders through mutual funds or by practicing individual stocks also you can buy. If you see the last previous studies, you'll find that the Sensex has a earnings growth. Last column, if you see, the Sensex has an earnings growth compounding of 14%, and it has created, the Sensex has grown at 14%, the earnings have grown at 16%. The wealth-based company, WealthX, have grown at 25%, and the earnings have also grown at 25%. So G is equal to R. Always you'll find that growth rate is equivalent to the amount of money you make in the market. Time and again, if you look at 5 years, 10 years, a lot of group of companies, typically you'll find that if you find a decent company, the rate of return is equivalent to rate of growth. So Nestle might be a very good company, most brilliant company in the world at 100%, 80% ROE, but if it doesn't grow, if it grows at 15%, it can, most likely the stock will go up by 15%. So clearly, this is what happens with a group of companies. The amount of wealth created in last 5 years is 138 lakh crores by top 100 companies. Now, top 100 companies are the companies which have, by market cap, these companies, they have beaten the pace of wealth creation has been higher than that of pace of Nifty rise. So some of the large companies like HDFC Bank have been deleted. I mean, they have not made it to the list, but these are the top 100 companies which have beaten the markets in last 5 years. So these 100 companies, they have created 138 lakh crores of wealth. You just see in 2001 and 6, it was just about 14 lakh crores. And steadily this has been climbing, and in 22, it was about 92 lakhs, and now it is 138 lakhs. So the size of wealth being created now, it is for the first time, now maybe second time, it is $1.5 trillion of wealth has been created by just 100 companies. So total wealth by all the 4,000 companies, it could be closer to $2.5 trillion. So now we are into serious wealth creation in economy in last 5 years. Now the next thing is, which is very strange, and this is a chart I would request to little focus on, that is the wealth destroyed. Typically what happens is, the amount of, you are made in 100, 200 companies, you have made, say, 138 lakh crores, but the amount of money destroyed by few companies like Vodafone, Bandhan Bank, Yes Bank, all these add up to just about 4 lakh crores, which is 3% of the total wealth created. So if 138 is created, only 4 lakhs is destroyed, which is very unnatural. It should not happen like that. There has to be 15 to 17%. That's a natural thing. I mean, if you come to the market and you can't lose money, then the whole world will come here only, because downside is 0, upside is 15, 20%. So that's the kind of situation we have reached, where there is no loss of capital in this market, or barely close to 0, and upside is like 15, 20, 30% depending on your pick. So if you see, in 2006, it reached to 1%. When that boom was there, 2003 to 6, that time we reached to 1%. Then 6 and 7 and 8, 2 more years it perpetuated, and then it collapsed. So this is the first year, or this is the first year when we are observing 3% wealth destruction. I don't know how long it will continue, but it is a clearly danger sign that market is heated, and be careful. For what reason it will go down, I don't know. Whether it will be global, local, or combination of global, local, something is going to happen whereby maybe after a year or two, God knows, maybe after 3 years of bull run, but it is setting the stage because you have reached to a stage where you cannot lose money in this Indian market. So this is a very strange situation to be, but that's what it is. You cannot lose money in the market at this juncture. So the study has 4 categories: largest wealth creators, fastest wealth creators, most consistent wealth creators, and all-round wealth creators. So here you have the most coveted wealth creators: Reliance Industries, 11 lakh crores in last 5 years at the rate of 20%. TCS, 8 lakh crores, Bharti Airtel, 5.5 crores, 5.5 lakh crores. So none of these top 10 are less than 3 lakh crores. So there's serious amount of money which has been made even by the large caps which have not done so well in terms of index movement in last 5 years. And so this is and the pace is also pretty good. So it's not that elephants can't dance. So we should not feel that only mid and small can make money and large caps cannot make money. My sense is that very reasonable pricing is there of large caps, though it is very unpopular and it is very counterintuitive to say that large caps will make money, but seeing the situation and when we go deeper into the study, you realize that probably the place to hide is large caps. Fastest is all kinds of companies: Adani Green, Adani Enterprises, and then Jindal Stainless Steel. So they have grown at literally 70, 80, 100% compounded in last 5 years. And the 6 companies out of 10 were about 6,000 crores. So if you really want very fast growing 70, 80% kind of growth companies, you have to buy the companies which are about $1 billion today. I mean, those companies which are 1 lakh crore, 1 lakh, 2 lakh crore, 2.5 lakh crore, they might be growing at 70, 80%, but they cannot deliver you what they delivered in last 5 years. We have to be very careful about that. And but then this portfolio, if you get one right, I think it can change the character of the portfolio. So the total return of this top 10 companies is about 77% compounded. And another thing I saw is that 5 out of 10 companies have P multiple more than 100 times. See, earlier 100 P was like a rarest of the rare phenomena. But look at the last but one column. Of the 10 companies, 5 companies have more than 100 P multiple, and we look at like as if it is a normal phenomenon. This 100 P has become crazy. So, and from here also they look to be, I mean, at least the managements want to be scaling to higher levels. And most consistent wealth creators they look a little more sensible, and only 6 companies have performed 5 out of 5 years, and there are 4 companies which have done 4 out of 5 years. The all-round wealth creating companies with the biggest, fastest, and consistent is Adani Enterprises, Adani Green, Hindustan Aeronautics. So these companies have beaten all the categories and come up to the all-round wealth creators. These are companies which should be seriously looked into what is really in them that they are fastest, largest, and most consistent. The industries which have done well, financials have done the biggest. I mean, they have contributed 16% despite the underperformance of private sector banks. The public sector banks have taken the nudge at this time, and they have really come up big time, 8 times, 10 times in last 5 years. Technology has been second. So these 2 categories, they remain very big, and they have not done so well in last 5 years. Despite that, they are the largest. So the future still hangs on them. But I think utilities, which were the kind of nobody bothered about them, that has come back. I think a lot of Adani companies are in the utilities, so that has contributed big time. Then another one which has done well is the capital goods. The capital goods have contributed, I mean, 4th largest is capital goods. I think one fundamental thing which has changed in Indian structure of growth, which we were looking at yesterday, is that one, the PSU banks, which were sick and down, they have come back, and SBI, which was literally at one point of time they incurred for 1 year, they incurred loss. Last year, I think they made about 67,000 crores of profit. Current year, they're expected to make 80,000 crores of profit, and maybe next year it might be closer to a lakh crore profit. So that's one PSU bank's profitability comeback is immense. Second, I think somewhere the consumption has taken a backseat, and the earnings are driven by capital goods companies like Hindustan Aeronautics or Bell and L&T and whole lot of them. So the earnings growth which has started from, we'll talk about it, but earnings growth has started taking off from 2019, from 2020 post-COVID. And there one fundamental change happened. Government went from 3% fiscal deficit to 6% fiscal deficit, and the whole thing went into the capex, government capex. And that changed everything. So consumer consumption remained stagnant, and the capital goods started growing, and that led to, I think, the earnings growth revival of 18 to 20% for last 5 years, and we'll see it in the charts going forward. I think this is the most dramatic graph, and it comes only in the wealth creation study, where the PSU, which were about 40-50% of the market, wealth creation in 2004-5, methodically kept on going down till about 2020. In 2022, it became zero. There was no wealth creation by any of the PSUs. And then from there, it has become 17%. 20 companies have contributed 17% of the wealth creation. And look at the data on the left, on the right, where still the earnings growth of PSUs, earnings growth of PSU, PAT growth is 29%, and private sector is 20%. And the current P multiple of private sector is 33, whereas public sector is 12, which includes Coal India, BP, HP, IOC, all sorts of large monoliths. But they're at 12 P multiple, and private sector is 33. You can decide for yourself. My sense is there is still a lot of steam left in this so-called unpopular PSU category. In terms of valuations, for the first time, turnaround companies, I think this is a study about the turnarounds, and somehow the data also says that in last 5 years, 14 companies have contributed 14% of wealth created, and they have grown at fastest rate of 46%. So now there is a new category, not low P, no low price to book, but turnaround companies, So they are large turnaround companies. They have done extremely well. Literally growing in every 2 years. That's the kind of the finding that even the loss-making turnaround companies, they can create magic in the marketplace. And this is a repeat of that. Price to sales below 1 is the place to look at. These are all rare numbers. Getting companies at price to sales below 1 is unheard of today, but that's the number which actually creates wealth. Payback ratio, next 5 years profit divided by current market cap, even that does well. Same is the PEG ratio, that has also done very well. So growth has been rewarded amply in the marketplace. Now, coming back to the real second part of the study. So that was about what happened in the market in last 5 years. The theme, bruised blue chips. Now, so what is the bruised blue chip, and how does it come into picture? So one of the things is that conventional thinking is about buying robust companies, robust blue chips into your portfolio, so that year after year it keeps creating their wealth. But we realize that even the blue chips, they also have rough times. They are not in a straight line. It just don't keep going up like bonds. They have a rough time, and when they are going through a rough time, that they get bruised. They don't lose the blue chip status, but they definitely get bruised. And best of the companies have been bruised for various reasons, for external, internal markets, out of the market, inside the market, but they do get bruised. And that gives you a fantastic opportunity to buy into them because they remain blue chips. Buying into troubled companies, potential turnarounds, is a contrarian approach. So from where we got this idea? So when we started the study, Srinath, who writes this study, he told me that this year let's do turnarounds. We ran the data on the turnarounds, but we found that we are not going anywhere, in the sense that we are not getting anything worthwhile, because everything looked to be very average. Then we said, we read the book again. We found a book, Making Money Out of Turnarounds, Bruce Berger or somebody. And this guy wrote a 30-page book, and there he said, if you if you look at the turnaround companies, the companies, fallen angels or companies which have gone out of, fallen more than 50% from their all-time high, look at the companies which are bruised blue chips, or second bucket is busted growth stocks. So we said, this busted growth looks to be a little crazy. Let's focus on the bruised blue chips. And that's how we picked up this particular theory, and then we worked upon it, and we found that study to be very interesting. I mean, this can be executed. In fact, I was always scared, and always I thought, my guru said that turnaround seldom turn around. So let's not bother about it. And that's how I was thinking. But yes, if you start with the blue chips, I think you have a good chance of making serious amount of money without, and with a very high probability that you'll make money. So let's do the study. So first thing is, everybody talks about blue chip, but nobody defined the blue chip. What is the blue chip? I mean, blue chip is in everybody's mind, it's a different thing. So how do you decide the blue chips? So we said, let's look at the companies which are the highest ROE in last 10 years. So return on equity is the best way to figure out the quality of the machine. So we said, let's look at the companies with above 15% ROE, which is also very stringent norm. Then we found that our top 250 companies, we found about 150 or 147 companies to blue. I said, it cannot be that more than 50% companies are blue chips. So then we raised the bar to 20%, and there we found that we have got about 107 companies, including the top 50 Nifty companies. So Nifty companies came because we can't say Reliance is, say, 14% ROE. So we can't say that Reliance is not a blue chip. So we said they are the leaders, they have the massive investments happening. So for some reason their ROE is low. So we said any company which is in Nifty, that also is called blue chips. So companies in Nifty to be blue chips, and companies with 20% 10 years ROE are also blue chips. Like that, we got about 107 companies. And that's what we have decided as a blue chip and for the studies. Now, bruised blue chips. What is the bruised blue chips? So this, if I'm talking about 20%, it doesn't mean that 19% earning is not a blue chip. It is also a blue chip. But for the study, we have to give a cutoff somewhere. And that's where we decided to cut off at 20%. So, I mean, everybody can have their own notion of, I'm doing with ROE, somebody can do it with the ROC, somebody can do with EV to EBITDA. So that's their call. But you have to look at the consistent performance for last 10 years. So that's the blue chip study, blue chip category. Second is bruised blue chips. So we said, borrowing from the book, bruised blue chips are the companies which has lost at least 50% from last 5 years high. So in last 5 years or maybe all-time high, if a company has lost, it was 1,000 rupees and it has fallen below 500, then you can call it a seriously bruised company, and then you start doing your studies, which we'll talk about it a little later. So those are two definitions which we have clearly started, because these definitions are not there, to start with. So we have said, unless these definitions are there, we cannot move forward in the study. So why bruised blue chips? So you see the golden opportunity of making tons of money at a very rapid pace in a blue chip space. So these are the top performing, those ideas, bruised blue chips. So look at the third column, where the amount of price fall. The companies, the best of the companies, Cummins, Bank of Baroda, M&M, Glenmark, they all have fallen more than, on an average, 60% from their top. This is the level of fall you can see in last, whatever periods we have talked about, 2010 to 14, high price, and low priced 15 to 24. So first 5 years is a high period, and next 10 years is the observation period, where the companies fall to the low levels. So price has fallen by 60%, and return from the fallen level is upwards of 50% compounded. And some companies like Cummins have given 80% compounded. So you have to be lucky to find this kind of companies and then buy a lot of them. That we'll talk about it, the position sizing, but this is what the return can be. And look at what happens to the valuations. The companies on average from 23 PE goes down to 8 P multiple. It goes down from 5.5 book to 0.8 book. These things have happened. We think in this market these are not possible. Ye sab hoga wapas. This is going to repeat for sure. And we'll see, what is happening in some of the examples we have given. So we looked at all these companies in last 7 periods of 5 years rolling, And if you focus on the last column, there are 78 average companies every year, blue chips, out of that 250 companies. Of that, 40 are bruised and 38 are not bruised. So 40 companies every year, they get bruised. More than 50% from that high, it goes down. Then what happens? The bruised blue chips, they fall by 75% on an average. 75%. And non-bruised, they fall only 28%. Since they have fallen low, they also appreciate only 23%. Whereas the one which has fallen by 75%, they come back at the ferocious speed of 55% compounded. So there is a case for the bruised blue chips to be studied. It gives an asymmetric payoff. So just think about it. If the stock has fallen by 75%, you have come down from 100 to 25. When it goes back to 100, it is a 4x for you. And 4x happens in 2 or 3 years. So it could be 70%, 80% compounded return. When the stock has fallen by 50%, it gives a doubler. Even if it takes 3 years, it is a 25% return for you. And the beauty is, downside is very limited. In investing, if once your downside is taken care of, upside will take care of itself. Because you are buying at prices, and they are deepest of the blue chips. We'll talk about the names, which are, we are not talking about some run-of-the-mill unknown stocks. We're talking about large leader companies like Bharti Airtel or Mahindra & Mahindra. These are big names. Telco, Indian Hotels. I mean, these are companies which are deepest of the blue chips. But they have fallen by the wayside, and they're given these kind of returns. But most important is that there is literally zero chance of permanent loss of capital. See, it is an art. Let's not make it very simple that just something has fallen by 70%, so let me go and buy and, you'll make money. No, it's not that simple. We'll come to that. But basically, you cannot lose money, but if you buy it well, I think you can be sitting on a multi-bagger. So what causes the blue chips to get bruised? There are basically 3 reasons. First, the stock market itself. The market can crash and everything can fall by 50-60%. We'll talk about that. Then company related, external to the company, internal to the company. And in most of the cases, all 3 come together. The company commits mistakes within, the company commits mistake outside, and the stock market also doesn't help. When all 3 come together, then you get 70-80% decline in the price. So let's talk about the stock market related bruising. 2000-2001, the Sensex went down by 56%. You imagine what would have happened to the stocks. In GFC, 61%. My portfolio went down by 67% in 2008. The 100 crore became 30 crores in 2000. And in 2008, my 550 crore portfolio became 225 crores. So these are real ones. Now at that point of time, nothing was spared. And if by chance companies are weak, people throw them completely out of the water. 2020, it was 38%, very recently in 2020. In February, it was all-time high. In March, it became all-time low. But it was very swift. In 2 months, I think everything happened. So those were the opportunities where the master minds, when the framework is in your mind, you are able to sell something in your hand. Of course, that would have also fallen. But you can convert something has not fallen that much into what has fallen too much. So what is the external to the company? So this is the stock market related. Now we are coming to the company specific problems. So external to the company, like economic recession, sector slowdown, adverse change in competitive landscape. We are seeing in various industries, telecom, paints, all kinds of things are happening. Adverse changes in government regulation. Government suddenly comes, this is allowed, that is not allowed. You are seeing in many sectors, these regulators play havoc. Then value outflow. In value migration, when like public sector banks to private sector banks. And then global events. So we'll give example of all of them. So like sector slowdown, look at Siemens. Siemens profit came down in 2012 from 850 crores to 180 crores. Stock came down from 743 to 186, 75% decline. These are all real numbers. Adverse change in competitive landscape. Bharti Airtel, when Jio made an entry, this is actually thousands. So 6,000 crores profit came down to make 32,000 crore loss in 2020. 32,000 crores in 1 year. And then the stock tanked by 50%. Adverse change in government regulation. IOC, this flip-flop in the government fuel policy, the profit of this huge giant came down from 11,000 crores to as low as 4,000 crores. Stock tanked by 80% to about 31 bucks. PSU banks to private banks, PNB, from profit of 5,000 crores to loss of 10,000 crores. The stock came down by 80% from 279 to 50, 60 bucks just 2, 3 years back. So, and global events, pandemic and all. Indian hotels came down from 350 crores profit to a loss of 250 crores. Stock came down from 156 to 60 rupees. You could buy Indian hotel at less than construction cost of the hotel. Forget about land and brand and everything. It was at a replacement cost of just the building. That was the kind of price at which you could buy Indian hotel, and this country could have not gone anywhere in next 5 years without hotels. They had become COVID centers, all the Indian hotels were COVID centers. So, environment creates these opportunities. Then internal to the company, capital misallocation. This is the biggest source of problem in successful corporates. When the corporates are successful, tens of thousands of crores start flowing in, and then the management doesn't know what to do with the money. And in India particularly, they don't know how to distribute the money. And when they don't distribute, they end up putting up projects or diversifications which are not great. So capital misallocation, weak, outdated management strategy, whatever is successful, whatever has brought them here, they don't change and they don't rejuvenate the strategy to take it to the different levels. Third, poor corporate governance, just the sheer bad leadership, which they don't accept that this is a bad leadership. Fourth, debt pile up. They become, in terms of acquisition and all, they just pile up thousands of crores of, particularly in the overseas acquisitions and all. And then deterioration in financial performance. So we have all kinds of, all the examples are there in this thing book. Capital misallocation, Tata Steel, they spent $12, $13 billion on acquiring Chorus. The stock went down from 92 to 19, 80% calculation. And you see lost 15 years performance. There is absolutely no, this brilliant company has lost its, charm because of foreign acquisition. Look at Hero MotoCorp, very big darling of mine, but they became the largest motorcycle company in the world, but they didn't change. They couldn't premiumize their portfolio. They couldn't make a success with their new products, and that led to profit decline, and the stock came down to as low as 2,400 or 1,500, sorry. So it was a 63% decline, but now they changed the management. And you see, again, it has gone back to 5,000. Poor corporate governance. At CG Power, it's a classic case of actually literally bankruptcy, and Murugappa Group comes in, Velayan comes in, and they rejuvenate. The stock comes down by 96%. It has happened right in front of us, and just last 3-4 years. Debt pile up. Jindal Steel, Suzlon, they went from 13,000 crores to 17,000 crores, 46,000 crores, and the fall in the stock price are 60 to 91%. Then what causes the bruises to to heal, Now how do you create the turnaround? So whatever is the cause of fall, it just reverses. So stock market related turnarounds have to happen with the markets coming back, which happens immediately after that. Second, company related, external to the company, that has to be corrected. Internal to the company, that also has to be corrected. So we have example for all of them. So all the sharp stock market falls, they lead to the sharpest possible recovery, and you get an opportunity of 2-3 months. In that window, if you buy, you're the guy who go to the bank. And the guys who just leave it scared, and actually you contribute to selling, those guys, they lose the opportunity. And external to the company, economic recovery, sector tailwind. So and all these things can happen together, So improvement in competitive landscape, favorable change in government regulation, all these things happen. So look at the Suzlon, which was completely out, and it had come to, I think the lowest is $2, 1.80 paisa or something like that. And so the stock fell, and then the tailwind started. The wind power became cheaper than the thermal power, and the world moved to the green energy, and this is where the sector tailwind came. I think market gave them 12,000-15,000 crores, and today it is more than a lakh crore company. What a classic turnaround it is. If there is one turnaround which is kind of And I heard the story, the whole management was there at 8 rupees in this office, and we are still kind of waiting when to buy. So, Sudan, I think we bought some, but not enough, knowing our nature when we hit the opportunity at 15, 16, I think it was possible. I think company also placed at 15 rupees, isn't it? And we refused to bite into it. But so it's a massive turnaround led by tailwind. Improvement competitive landscape. So Bharti, the entry of Jio destroyed the profit pool. Whenever a big giant enters in any field, there is a destruction of the profitability because other side doesn't allow them to enter very smoothly, and hence he has to disrupt the profitability of the industry for some time. And that is a period when the 4 quarters result come, they are very bad. So telecom went into loss and the stocks became completely worthless. So much so that Vodafone is today a sick company. But the companies which survive, like Bharti, when Jio became from a challenger to an incumbent, they also want to make money. And now both are minting money. So now the stock has come from the 200-300 rupees to as high as 1500-1600 rupees. DLF, I think this is a favorable change in government regulation, that is RERA came in and the market has also healed now. And here the stock was at less than 100 rupees for a very long time, very long time. And today it is at 800, 900, still it has not hit the all-time high. I think all-time high is about 1200 rupees. I bought at 400, sold at I think 600-700 last round. It went to 1200, still it is about 800-900. So there is so much of opportunity that, it did come to me that at double-digit price, we must buy DLF. But somehow we didn't execute because we didn't have the framework. Now I have the framework. I hope I get yet another opportunity in the future. Internal to the company, all kinds of restructuring, change in management team and strategy, corporate restructuring, new product launches, cost control, debt reduction, recovering the finance. So whatever is required, whatever it takes to turn around, that has to be done. So M&M, we'll be discussing, Mr. Anish Shah will be here for the panel discussion. We'll hear the story right from him, the person who has done it. And the company which was making 750 crores profit literally became profitless. And this gentleman comes and turns around, and now it is 11,000 crores profit just in 4 years. They never had it so good. It is the most expensive, most valued, not expensive, most valued auto company. It is more valuable than Telco and Maruti. So when the turnaround happens, they go for the
Recording
kill.
in progress.
They just don't go back to where they started. They have become, they started from 600, came to 300. From 300, they didn't go to 600. They've gone to 3,000. And now the ambition is to go to probably 10,000. So I think when you buy this kind of companies, you also know about them. Change in the management team. ICICI Bank, it was about, how much? It is about 12,000 crores kind of profit, came down to as low as 4,000 crores profit, and now it has reached 44,000 crores of profit. Yes, Mr. Anish Shah is here. Welcome, sir. Please have a seat. I think just to refresh, Mr. Shah, just last slide I showed about Mahindra & Mahindra, corporate restructuring, completely authored by you. In 2018, the profit of the company was 750 crores, and by the time you joined, I think in 2020 or something, it was literally flat, zero. And from there, it has become 11,000 crores last year. I don't know how much it will be, 16 crores or 15,000 crores current year. So this is something, actually to go down the history, what could be the size of turnaround one can underwrite. Okay, new product launches. Indian Hotels is another, very recent story of post-COVID, where they have launched the franchised, kind of properties, villas and hotels under the brand name of Taj, but managed by them, but not owned by them. So they are following very asset-light strategy. The ROE, which used to be 13-14%, now they will start shooting up to 20-25%. So it will be a very different kind of a hotel company as we go forward. Stock has moved from 70-80 rupees to now 800 rupees. And this is just about 3-4 years story. Cummins India, the most brilliant cost control led healing of Cummins India. Of course, they are passing through low capex kind of a situation, but from 11% EBITDA to 19-20% kind of EBITDA, the stock shot up from say 100 rupees to more like 600 rupees and still counting. Debt reduction, same Jindal and Suzlon and all, they are literally now debt-free, net cash companies. And the stock has done, Jindal Steel is up 14 times and CG Power is up 17 times. So these are all very, very new, last 5 years story, post-COVID. So process of investing in blue chips, now, so we have established the case for investing in blue chips, enough we have talked about that. Now what is the process of doing it? So create a watch list of bruised blue chips. The moment the stock falls, first establish the blue chip status in your mind. Second, create a watch list of bruised blue chips. Like I want to track these companies. Say M&M I want to track, Indian Hotel I want to track, Telco I want to track. So whatever companies you are comfortable with. Third, await for the healing triggers. Just because they have just fallen sick, it doesn't mean that they have started recovering. So wait for those triggers to come. And market will give you enough opportunity. Market will always be skeptical that they have done the job. I remember in M&M when they sold Sangyong, I never believed for the next 6 months or 1 year that actually they have sold it. I thought they would have subsidized it or something. The headache is still there somewhere. You know, because these foreigners, they don't allow you to get out. So, but Anish had done a good job. So, you know, this skepticism is there in the market for a very long time because people have burned their hands. Buy only if the company's future prospects look good. So, just by statistical fall, you cannot buy. You have to understand, again as an investor, that prospects are great. Not only they'll survive, they will prosper. That call has to be yours. And then, I mean, I avoid talking about capital patterns, but there is the book at least recommends that use some technical, very basic level of technical analysis to figure out the point of maximum pessimism. I think Atul and all can help people in terms of finding the bottoms of fools and liars, but still you can take technical help to shorten the value trap or the waiting period for the recovery of the companies. The average price of bruised blue chips, they come down. I mean, look at the 7 studies and where do they come down? On an average, they come down below 2 book. So one of the conditions is that the price must fall to below 2 book. I mean, right now it's like a dream below 2 book, but yes, it does happen and it will happen again in future. Yeah, so this is the current list of bruising. I think as of 28th November, these 11 companies, they have a correction of 30 to 80%. Adani Total Gas is down by 80% from their all-time high. Adani Green is down 64%, Enterprises down 42%, and Gujarat Gas down 39%. SBI Cards is down 39%. Avenue Supermart, DMart is down how much? 37%. Asian Paint and Berger Paints are down 32-33%. So there are enough bruising is on even in this market for blue chips. Yeah. So now I'm to the last segment, market outlook. Here, if you look at the significant recovery from 2000 bottom, corporate profit GDP has moved up from 2.1% to 4.8%, which is very close to the last time peak of 2008, which was at about 5.2%. The market cap to GDP, the valuation of the market is at all-time high at about 140-141%. So that is clearly reflecting the current euphoria in the market and elevated levels. The P multiple is still okay in the sense that average for last 10 years 23 and we are at about 24. So not that much alarming, but still at the higher end of the spectrum. The real story is that of retail participation. The demat accounts from 40 million in 2020 has crossed 182 million as of last month. The SIP numbers have crossed 25,000 per month. So what that has led to these three, I would say summarize the current market condition. FI flow, nobody can predict whether they'll be in or out, but very rarely they sell. Year before in 22 they sold about 17-18 billion. In 23, they came with 22 billion plus. 24, they are flat, neither in or out, but total they have not sold anything. What it will be next year, we don't know. DI, $60 billion of flow and is still on. So I think if that 60 billion continues in 2025, so that is, I'm saying that that is given, maybe 60 or 70 or 80 or 40, that depends what is the size. But going by the current numbers, I think 50, 60 billion is given. Now corporate earnings, which is in our hands, that grew at about 21% between 20 and 24. That is kind of failed in the sense that in the first half it has not grown, and our research department has downgraded the earnings for the current year. But most likely, as second half capex, government capex picks up and it gathers momentum in the first half of next year, I think we are going to see a return of the earnings growth in 25, 26 to a level of 15 to 17%. But that's a iffy call. We don't know. If that happens, foreigners will also come. So if the earnings recover, I think you are going to have a party in the sense that the domestics are going to buy 50, 60 billion and foreigners are also going to buy 20, 30 billion. So I think the markets are going to, could be, there is a good chance it could be euphoric, but if by chance earnings don't come through, then maybe the markets will be current levels or it will consolidate here. It may not go anywhere. So the crux is corporate earnings growth. So market outlook, FI flows are unpredictable but strong. FI flows are unpredictable. DI flow is strong. Predictable retail-led DI flows will play a major role in the market behavior. And I think on a 2-year basis, the best is yet to come. Next year, maybe we may not be sure because of the corporate earnings and FI flow. But if you take a 2-year view, I think the best time is yet to come. We could see 30,000 crosses on a 2-year basis rather than 1-year basis. So to conclude, blue chips are aspirational investments, but mostly richly valued. So most of the people, they avoid that. Bruised blue chips are the ways to get into blue chips and buy for handsome returns. Probability of permanent loss of capital is close to zero in these bruised blue chips. The framework to invest in bruised blue chips is create a watch list, await for the buying triggers, and buy at attractive valuations. Wealth creation in last 5 years is the highest ever, but wealth destruction is zero. Please don't ignore this particular fact that there's no destruction of wealth, which is not a very healthy sign. PSUs are regaining prominence in wealth creation, so don't hate them the way we used to hate them earlier. For Indian equities, the best is yet to come. Thank you very much.
Thank you, Raamdeo for a very interesting and insightful presentation. I'm sure everybody here is, and people who are watching are itching to go and find those bruised blue chips. But before that, I can assure you we have a very, very interesting panel discussion, which is going to discover further layers into how do you spot bruised blue chips and create wealth over time. So to moderate this panel, I would like to invite on stage Prashant Nair, Executive Editor at CNBC TV 18. He's a very known face. I mean, he's on CNBC every day. So he's a seasoned journalist and is a very respected expert in capital markets. And with his in-depth knowledge and prowess on investing, he will, I'm sure, discover several aspects of bruised blue chip investing. So Prashant, may I invite you on stage, please? Oh, okay. And to join Prashant, we have very, very interesting panelists. A couple of them are corporate heads who've been through bruised phases of their companies and turned them around and created a lot of wealth. So let me first invite on stage Dr. Anish Shah, Group CEO and MD of the Mahindra Group. A visionary leader, Dr. Shah has been instrumental in driving Mahindra & Mahindra's strategic turnaround by optimizing capital allocation and streamlining operations. His leadership has seen the successful launch of key products like the Thar and XUV 700, strengthening Mahindra's position in the competitive SUV market. He's also spearheaded the group's ambitious push into electric vehicles, cementing its leadership in sustainable mobility solutions. Dr. Shah, we are all eagerly waiting for your new launches in the auto segment and, of course, your views today evening. Next, Mr. Rohini, Mr. Akhil Gupta will be joining online. Okay.
Yeah,
Has he joined?
I'm there.
Yeah, so let me also welcome a second panelist who will be here attending on Zoom. Again, a doyen of the doyen of corporate world, Mr. Akhil Kumar Gupta, Vice Chairman of Bharti Enterprises and recently appointed Chairman of Bharti AXA Life Insurance, a pioneer of India's telecom revolution. Mr. Gupta has driven Bharti's phenomenal growth through transformative strategies, global partnerships, and successful public listings. Welcome to you, Mr. Akhil Gupta.
Thank you.
And our third panelist today is a stock market practitioner, Mr. Amit Goela from Rare Enterprises, a firm synonymous with legendary investment success. Welcome, welcome Amit. With decades of experience in the financial markets, Mr. Goela played a pivotal role in developing exceptional stock picking capabilities alongside the late Rakesh Jhunjhunwala, one of India's most celebrated investors. And last but not the least, Raamdeo ji, you're needed. Prashant is here. So over to you, Prashant.
Check 1, 2, 3.
Check करो. ठीक है. चेक करो फिर फोन करो.
Mr. Gupta, can you hear me?
Yeah, now I can.
Hi, sir. Good evening. Prashant here. We're just
Evening.
starting.
Good evening, Faisal. Thank you.
Good evening, ladies and gentlemen. Great to have all of you here. We are, of course, coming to you from the sidelines of the Motilal Oswal Wealth Creation Study. It's the 29th edition. Each study, of course, is something to behold. It's a study into which a lot of hard work goes in. Raamdeo ji, of course, spearheads the study, but an entire team is involved. And of course, it's been our pleasure at CNBC TV 18 to bring this study to you year after year. As I said, it's a 29 study. Raamdeo ji was earlier joking with me that at least about 5 years of his life have gone into the wealth creation study, maybe more. And we'll get to it in just a bit. It's a very specially curated panel that we have with us today because we will hear not just from investors. We have Raamdeo Agrawal, of course, with us. Amit Goela needs no introduction as well. He's a veteran investor, partner at Rare Enterprises. He's been with Rakeshji's side for 20 years plus. And he's, of course, seen the ins and outs of markets for a long, long time. But we'll also hear from corporate veterans. Anish Shah is Group CEO, MD at Mahindra Group, someone under whose watch the Mahindra stock has gone up about 4 times. Anish, great to have you with us here. Thank you very much. And of course, Mr. Akhil Gupta joins in as well. He's, of course, Vice Chairman at Bharti Enterprises, someone who's, again, been in a sector which is, I think, has been a tricky one over the last 2.5 odd decades. But Bharti, of course, under his leadership, has emerged as a big, big winner. So once again, thank you all for being here. Now, the topic for the discussion, of course, is how to profit from bruised blue chips. And that is essentially what we're going to be talking about. There is, of course, the wealth creation component part of it, which I will get to in just a bit. But I think it's really interesting how to profit from blue chips which have fallen out of favor. Bruised blue chips, as Raamdeo put it in his study. So, Raamdeo, why don't you set the context for us? What do you mean by bruised blue chips? How do you decide that they are really bruised? And how does repair happen? And when do you buy them?
So I think there are 2 aspects. One is the definition of blue chip itself, and then how do we define the bruised blue chips? So blue chips are the companies which, in our view, earns at least 20% return on equity for average return on equity for 10 years, and that does the magic of creating wealth for the companies. So 10 years of average return on equity, there are not many, maybe 20, 25%, 22% of the listed companies in top 250 are blue chips. And then also by size. You need to have size and stability leadership. So top 50 nifty companies and the companies of 250 at the companies with 20% ROE, we have termed them as blue chips. Because blue chip is practiced all over. Everybody talks about blue chips, but nobody tells the definition of blue chips. So we have defined for the study definition of blue chips. Second is, what is a bruised blue chip? Bruised blue chips are companies in last 5 years, whatever is the high, and now the companies have fallen by more than 50%. Say if company has gone to say 1,000 and it has fallen below 500, 60, 70, 80%. So those companies are bruised. They have not lost the blue chip status, but for some reason, competition or failure products or regulator or whatever, the stocks have fallen by more than 50%. That we call them bruised. So these are the 2 things which we have to keep in mind while talking about bruised blue chips.
Typically one would imagine, Raamdeo, that blue chips don't get bruised, right? Once in a while they do. COVID happens or the GFC happens, but otherwise blue chips are blue chips. But as your study shows, they do, and quite regularly.
Yeah, quite regularly, every year. If you see the study period of 5 years, every time out of 250, 78 companies are the blue chips on an average. And of that 40, or literally half, they get bruised. Other half, they don't get bruised, as you say. But 40%, so no blue chip has traveled the journey without getting bruised. Maybe TCS or Infosys might be 2 or 3 companies, but actually almost all the companies, they go through a rough patch, and that is the point of time when they're deeply bruised. I think if you understand the company, you can buy tons of them.
And as your study shows, the hit rate is pretty good. When you buy them at that very, very bruised state, you tend to make a lot of money.
I have not practiced. Probably Amit can talk more about it, because for me, this is just the study.
Right.
But if you practice it, few companies I know for sure, which came to my mind, that was one of the Jindal Steel. Since I know that company, DLF at 70, 80 rupees, I have gone on record saying that this is a great time to sell your real estate portfolio and buy into DLF. So 2, 3 companies I remember, but I have not made too much of money out of bruised blue chips.
That's a cue for you. Raamdeo says he's not practiced it, but you've been a big practitioner over the last 2 decades plus. So tell us a little bit. You heard the presentation earlier, you heard Raamdeo explaining it.
One of the core style of dear Rakesh and your mentor and partner and boss, I think he had the unique style of picking these companies. Yeah. Because whenever I used to meet him, he used to tell me, this is the Raamdeo, this is the stock I bought, why don't you buy them? Chahe Scores ho, chahe Indian Hotel ho. But I never could see the light of why he's saying so. In fact, I used to feel this guy is already drunkard, and probably he's telling me something which he wants to pass off. That used to be my feeling. I never made money out of it. And he was so sincere. He always wanted me to make money. Yeah. And now I can see that what he wanted. But it's too late. Anyway, Amit.
Yeah, Raamdeo ji, thank you for having me here. So Prashant, as you said, I've been with Rakesh ji. So Rakesh ji was the practitioner of this kind of investing. I was supporting him, I was helping him doing the work, but the real practitioner of was Rakesh ji. And I've seen him consistently over a period of time pick stocks like this which were in trouble or the companies were in trouble, and he's made serious money in them. And the quote, the starting, he never coined them as a bruised blue chip or anything of that kind. He was a value investor. And his starting point was that cannot be a loss of capital. See, he would invest through leverage. And he would service the debt through either dividends or from trading income. So there was no question of a capital loss. So anything which was like a book value, though I don't even remember calculating too many times around when I was around him. But PE was quite critical and dividend, like sometimes most of these companies were not even giving a dividend because they were in bad shape. So the PE was very critical. The market cap in terms of the opportunity, that was very critical. Those are the couple of things he would look at. And his basic core was there cannot be a capital loss. So he said, my edge is I have time on my side. I'll keep sitting tight. I don't have any benchmark to beat. I don't have to prove anything. And so I will remain invested, but I cannot have a capital loss. That was his basic core of investing in these kind of companies. And he had a very open mind. So he didn't, it was not, I will only look at one sector. He invested across sectors. We were sector agnostic. Yeah, like so.
You know, let's get this very well put, Amit. Anish, uh, you know, we get the investors' viewpoint all the time, but it's a hall full of investors waiting to hear from you and Akhil. You came into Mahindra and Mahindra, and I dare say, Eminem was not bruised, but it was going through a tough patch. And you came in and you turned things around. Talk to us about that point when you came in. What was on your mind? What was the task given to you? And generally, what were the conditions? I mean, what was the experience like?
The start of the first phase of my role, the first year was as Deputy MD and Group CFO, began on 2nd April 2020. And that was a time when we had just hit a low point. The stock had lost about 70% of value. SsangYong was a major burden, and we had close to 5,000 crores of losses from what I called our loss-making entities. And as a result, the results of that year were just about break even. And it was the start of COVID and no revenue for the first month of April. So that was the starting point. But the foundation was very strong. And that's one thing I want to highlight in terms of the Bruised blue chip story is that the foundation had been built over many years, and in fact, it was a Motilal Oswal analyst report that in 2018 had highlighted that M&M was the best performing stock in the Nifty since 2002. And that doesn't happen easily. So there were many elements of the company, of the group, that were important and took us forward and helped us weather the storms. Yes, there was some reason for the storms, but the people we had, the talent was of a completely different quality. The ethos of the company, the purpose-driven approach, the focus on entrepreneurship, all of those were elements of the DNA of the company. And which is why even through those storms, we never really were very concerned because we knew that we were going to get out of that very easily. So I give a lot of credit to our predecessors who really helped set us up for success. And we had to just go forward and implement the few things that we felt were important.
You're being very humble, Anish, and very nice to people who, of course, and rightly so. But I think what we want to know is what did you do? I mean, you set the ball rolling. You set ROE targets, and you sort of decided to sell off some of these unrelated diversifications and all of those things. I mean, just talk us through. I mean, the point that Raamdeo ji made: external mistakes, internal. Sometimes you kind of sort of go astray. Large companies. So just talk us through those moments and what you saw.
So let's start with the losses. We knew that we had to address that, and we had to do that quickly. And therefore, we created a list of companies that made that 5,332 crores specifically of losses. SsangYong was highest on the list with 2,400 crores of losses that year. And we said that if we are to be credible, that's the first decision we have to take. And Raamdeo ji is right. A lot of people at that point said, you said this, but it's not going to happen. Right? And therefore, we had to make that happen. But that wasn't enough because we still had another 26 or 2800 crores of losses. And therefore, we had to exit a number of other companies and we categorized them. We said, look, some of them actually could be good jewels for us if we can turn them around. So our categorization was category A, companies that can be turned around, and they will be companies that we'll be proud of and they can meet our 18% ROE target. Category B, companies that will likely make some losses but have a quantifiable strategic benefit for us. And category C is none of the above and therefore they need to exit. And we exited 15 companies in the next 18 months or so. And we just moved very quickly and did that. We did not wait in terms of any sequential order. We just started that simultaneously. So that was the first big step. The second big step was pivot to growth. Because just meeting an 18% ROE target is not enough. If you don't see EPS growth as investors, it doesn't matter from an investor standpoint. So we very quickly pivoted to growth from there. And we identified a set of companies that we thought were very strong and what we call the growth gems. And these were strong because they had a strong position in their industry, at least from a potential standpoint. They had a strong, what we call, right to win. And these growth gems collectively had valuation of less than $1 billion in March 2020, close to about 900 million. And the first thing we did there was to say that if you have an aspiration to be $1 billion company standalone, you'll be called a growth gem. And the aspiration has to be matched with a plan that in the next 3 to 5 years, you will be $1 billion company. 3 years later, the collective group had gone from 900 million to 3.4 billion. And we raised the bar. At that point, we said that to stay a growth gem, you've got to now grow 5x in the next 5 to 7 years. So that 3.4 must go to 17. And that's one part of what's driving our growth now, is the ambition as well as the ability to then deliver on each of our businesses.
You communicated obviously very clearly internally. Did you communicate as you were going along externally as well to the outside world, investors, the investor community?
In June 2020, June 12th, 2020, we communicated an 18% ROE target. And the basic response back from investors were, you're crazy, there's no way you're going to do this. Right?
But how did you arrive at 18%?
Because we just looked at it first to say that, look, if we take 5,000 crores of profit out, or rather losses out, right, that comes in. And here are certain growth targets which we think we can meet. And therefore we said, to be on the safe side, we'll get to 18% in 3 to 5 years. But we got there in 18 months because we could move quickly on getting those losses out and we could meet certain growth targets that we had laid out. So it was a very deliberate target based on here are the specific actions. If we take these actions, we get there.
And all these actions you did, you had a full authority to, because all these companies were collected by Mr. Mahendra with a lot of pain and effort. So did he give you full authority to just chop it off?
So the answer to that is yes. And that is one of the privileges, or I would say that something we're very grateful for, is that the teams were fully empowered. I would, in all cases, go back to Mr. Mahindra and seek his guidance. And he gave very good guidance in a number of areas. And he always used to say that, look, your goal is to create investor value. And you do what's right for the company. And that is how we worked.
Amit, you want to come in as investor's perspective?
Yeah, so I wanted to add two things to this. One, the turnaround becomes all... Sorry. I wanted to add two more things to this. The turnaround becomes all the more creditable because it was done during COVID. They made the announcement in August 20, like when you came up and said 18%. So that was in deep COVID. And then the follow through. And I have not seen a more publicly telegraphed and told to investors turn around, which has happened. Quarter on quarter, he would come on the conference call, he would put up the capital allocation chart, and he would say, look, this is what I had said and this is what I'm doing. So all you had to do was to keep listening to the conference calls quarter and quarter, and you would have made serious money. I'm not joking. 20 years, I've not seen this kind of a telegraphing of a turnaround which has been happening on a public platform.
And when did you buy it? Fine.
See, we had been tracking Mahindra because we had owned Escort. So, like, we had been tracking it for a while. Like,
No, but did you double down once?
not this one.
You wish you.
We didn't, unfortunately, we didn't.
You wish
buy
you
it.
did,
very,
obviously.
Very, very insignificant position. I wish we had done it. Yeah, like, so.
But why didn't you? I mean, was it because you?
We had already invested in Escorts, Tata Motors. There was quite a heavy exposure in autos.
Raamdeo, you said.
I think you had gone into telco big time, isn't it?
Yes, we had got
They had taken at 70 to 90 bucks. They had bought 5% of telco. So now they can have only that much appetite for auto sectors.
Raamdeo, why did you not? You
I
said.
didn't have the framework. I used to think that any company which is going down, good Lord, I don't have that stock. I mean, I was about QGLP, robust companies growing, going to the sky. You know, I mean, we always paid full price for the growth stocks. We were never practicing the companies which are going down. It was never in my, syllabus to buy the companies whose earnings are going down. No, I never looked at it. That's why, for me, it's a very, very important study. Now, when Asian Paints or anything is falling, it's an opportunity for me to look at, are they getting bruised enough for me to step in? And at some point of time, with the grace of God, probably will hit the opportunity.
So I think you're giving us what आपकी नजर कहाँ है? Asian Paints. उस पे बात करेंगे.
Let it happen. See, till it has happened 50%, let's not bother about it.
I see. Let's bring in Mr. Akhil Gupta, who's been listening in keenly. He's got a smile on his face. Mr. Gupta, thank you for waiting patiently. Tell us a story about Bharti. I mean, as I began by saying, it's a sector which is, I think, since '99, I mean, it's a regulation is one aspect, competition is another, and of course, you went through a very large player coming in, disrupting the market in a very, very big way. Tell us that story, Mr. Gupta.
First of all, my sincere apologies for not being there. You can hear me, I hope. So, sincere apologies. I really wish I was there among the stalwarts. Raamdeo, what a fantastic study, and how modest you are to say you did not catch this trend. So, really a great lesson. Well, telecom industry in India has not only been bruised, it has been battered. It has had existential crisis, not once, but twice. And so it's been a great journey. And some of the things which we learned in this journey was to stick to some fundamental beliefs. And those beliefs were, one, that in difficult times, strong companies become stronger and weak companies get weaker. Two, that to remain strong, the one major thing you have to take care is your balance sheet. Therefore, whatever you do, keep the balance sheet strong. And third, you got to keep your flock, your people, really motivated. Of course, strong balance sheet helps in doing that, because the biggest demotivation for people is when you're not able to pay salaries on time, you're not able to pay vendors on time. I think steadfastly, through very difficult periods, we stuck to these three mantras. And so I think we were able to sustain and get over those very tough periods.
So, the second bruising, as you called it, the second episode, the crisis, as you called it, when Jio made its entry, and it was in the process of garnering subscribers, and it very quickly reached a very significant, large number. You kind of stayed the course with these three mantras, as you put it. You knew that you would come out stronger on the other side. You had to, or was there a moment of doubt? You had to do something.
Absolutely.
Sorry.
Yeah, I think we had no doubt, because first we had no choice. You know, unlike many other groups, we only had telecom. When nothing to say, we can shut it down. So we had to stay the course. And we really believed in this mantra that if you can get over this difficult period, you will emerge stronger. which we really did. Oda idea fell into difficult time because I think great company, but somehow it just could not manage the balance sheet.
No, absolutely. Ramdevji, come in here. Investors' perspective on, because you've seen this. I mean, I think this is, you're right there. I mean, if anyone knows this company, you do. So
No,
talk
no,
to us a
I
little bit.
made the fastest money here, but not as a falling company. As a growing company in 2002-3, at 25, they came out with public issue, I think, at about 45 bucks. And in 2003, January, they declared the break-even. And then at 24 rupees we bought, and the stock went to 1180 in next 2.5 years. I mean, 50x in like 2.5, 3 years. So that was the ride I had. And that's why I have been meeting Sunil and Akhilji off and on. But I was stunned to see the kind of capital management they did, in the sense that they went to Africa because they had so much of cash flow. They didn't know where to deploy. And so I don't know whether I would call it as a capital misallocation, but I think Akhil never agreed with me. But what's his view? I would like to listen.
Yeah, I still don't agree. We did have a difficult time in Africa, but that was, I would say it was a growth market. But of course, some of the currency problems have been very severe, which we never anticipated. Nobody can actually. Not a terrible decision, but yes, some internal mistakes in terms of execution. We are back on track, and I think ultimately we will emerge. We have come out of the shadows. So not a real bad capital allocation in 2010 when things were just phenomenal. We were making so much money that if we were not able to grow at that time, it would have been not good for the investors.
Amit, you have any thoughts on the Bharti story? I mean, the latest episode, what we talked about. I mean, what were you doing around that time? Did you look at the stock? What were your thoughts as an investor?
No, Bharti's done a phenomenal job of turning around things. They faced maximum pressure at a point of time. As an incumbent operator, whatever I have read and experienced, I don't think an incumbent has ever faced this kind of a pressure from a new entrant. Like it was like in basketball, you say full court pressure. It was that kind of pressure here, like. So, and they fought back and they came back, which was quite extraordinary here, like so. And I think now they're here to stay, like so. They fought it and they fought it clearly on customer service, and and they brought down their cost to be able to operate at the structure at which the new person was operating.
Yeah, the change from a minute-based pricing to a database pricing, I think I mean, these guys, Bharti, was earning money by selling the minutes.
Yeah.
And I mean, here comes Yo, he says that there is no minutes. You have a flat plan of 100 bucks or whatever at 200 rupees, and they're selling data. In fact, it was a complete migration from, say, cellular telephone to digital telephone. And the business plan, the tariff plan was completely different. It's a very disruptive thing to move from minute selling to flat plan. And that to flat plan, literally nothing. I mean, they pumped in 5-6 lakh crores, and I mean, they wanted that 50% market share. So there is a complete bloodbath on this thing. I mean, when you see from outside, I couldn't believe that anybody will survive. And now they survive, now they're prospering, and I think the best days are ahead. So, I mean, that's what has happened in M&M. They not only survived, now they're 11,000 crores profit that of last year. I don't know, this year they'll do 14, 15,000, and the ambition are like even more. So they go for kill. See, one of the biggest thing is that you buy free option when you buy a successful turnaround companies, because you are buying for a doubler or tripler. But actually, when the management is actually successful, they go for the kill. Now, this management in M&M or Bharti's management, they are not going to stop at whatever they are making. They will go for the, kind of a big, and the big thing is they went into trouble at $4 trillion economy. They will come out in $8 trillion economy. So opportunity size is multiplied, profit pool is increased, and they will go for the best. So I think in Mahindra and Mahindra, at least we are seeing 10, 11, 12,000 crores profit. But in Bharti, I think ROE is still pretty low. How do you see the future? How do you see where exactly, when will you ever eat 18% ROE of Anish?
Are you asking me?
Yes.
Okay. Well, in our peak, we had an ROE of about 32, 33%. So, obviously, having an ROC of 12% and ROE around that is not something we are very proud of. This industry still needs a lot of repair. Undoubtedly, we have turned around, but there is such a long runway to cover. And I won't say when, all that I know is we will keep moving forward. Our investors, any investor in the market, at least deserves a 20% ROC. And that's what we believe we have to keep working towards.
No, that's very well put. Anish, by the way, Ramdev said once you start, I mean, for the person who's coming in at the lows, it's a doubler or a trebler, but when the new management takes over, they don't stop. It can go anywhere. So you want to give us some sense of where M&M is headed? I mean, without, uh, just a broad idea. What's the road looking like for M&M from here?
So for us, our focus is really on continued execution. In terms of your question, you know as well as I do that we can't give any forward-looking guidance on this part. But what we feel proud about is the fact that across our businesses, things are moving very well. And we are no longer just an auto company. In fact, if you look at the last 4 years, what we call a services business has generated more cash than either auto or tractors. And that's something we've talked about publicly as well. So we started to see all our businesses really live up to their potential and drive significant growth for us. And what we want M&M to be looked at as a company that plays in 70% of India's growth over the next decade. And while we have leadership positions today in auto and farm, we have businesses that are very well poised to take leadership positions in multiple other sectors in the industry.
When you buy, Amit, as an investor, when you buy some of these sort of bruised blue chips, it could be a long gestation period in that sense, right? So talk to us a little bit about that mindset. How do you decide? I mean,
No, yeah, the gestation period is infinite. It can be 1 year, it can be 2 years, it can be 3 years. See, once you bought this, you are in because you normally would want to buy it when, at least what I have seen was that the commitment was very strong. When you identified something like this, you would back it up with and put serious money behind it. So there was no question of entry, exit, getting in. So you were in it. And so there have been periods when the stocks, I have seen stocks which have been bought in front of me for 1 year, 2 years, they've done nothing. So we've been plagued with serious self-doubt, serious frustration. We have felt at a point of time there were 3, 4 stocks in our portfolio which were turnaround stories. The markets were booming and we thought we are sitting in a bear market. So it's very difficult to go through these periods. You really need to be convinced. See, look, money can't be just gone and you can't find a 10-bagger, 20-bagger like that. Yeah. So you have to go through the pain, and we've experienced, Rakeshji's experienced serious pain. Yeah. He's not only experienced serious pain, he's experienced serious drawdowns from the time he has bought the stock again also. Even at the low levels from there also I've seen some stocks heavy.
Why don't you talk about your escorts experience? Because
So
you guys minted money in that, but the kind of pain you went
Yeah,
through.
so escorts for 3 years did nothing. And it was during, we bought escorts in 2013. Rakeshji bought it in 2013. 14 to 17, the mid-caps went basak when Mr. Modi came. Escorts did nothing. And it was a very large position for us. So we were continuous self-doubt was there. We would keep examining our position. We would keep thinking what is happening. And as it is, like Mahindra was a 40% player. They were a 10% player. Are they doing it right? Even the external factors were not good. The weather situation was not good. Competition was discounting. So it was a very tough period for 3 years. But then suddenly when things started turning, they turned around much faster than anybody could have expected. And it was just a dream story after that. Yeah.
any other examples come to mind? Any other name like Escorts? I mean, just to kind of run the audience through the experience of going through it.
How was the experience in Titan?
So, see, Titan is a story which everybody, like what Rakeshji is associated with. It has been his best pick and closest to his heart. And I was just since you called me for this, I was going back and looking at some numbers. So while Titan has been 1000x since he's bought it, I went and looked at what the balance sheet was when he bought the stock, okay? Like Raamdeo ji had put up over here that it's a bruised blue chip, what it is, and this kind of stuff. You guys, most of you, I don't think have looked at the Titan balance sheet, what it was at that point of time. Okay, Titan's market cap was 250 crores. Titan had 750 crores of debt. Titan's profit had come down from 23 crores to 8 crores. Titan's jewelry business had started, but it was just it was just emerging. Watch business was there. They had lots of money blocked up in working capital. So to go and buy an infected balance sheet like that, because he was convinced that the Tata name, the jewelry market is disorganized, and the Tata name will lead to people coming and buying jewelry, and the jewelry market will get organized. So this was the kind of balance sheet he invested in, sir. So while it's very good to look at the chart when we see right-hand side compounding, ownership for lifetime and all those things. And so you go back and look, so you see what kind of foresight was required, and then the courage to put serious money at that point of time, sir.
Yeah, he made a good point. Not only you need insight, you need massive foresight. You know, that foresight thing was there with Rakesh. Actually, in Titan, to be fair, for one of the institutional investors, I sold the stock from 140 to 30. After that, we stopped selling. And then one day I realized that all the leftover things have been bought by him. You know, so I'm the guy who sold the stock and he's the guy who bought it. You can see the difference. I made I made 25, 30 basis point brokerage and he made 1000x.
And Prashant, it's a 20-year holding now. And you've seen drawdowns where like you've lost 50% of your value. So it doesn't happen easily.
No, absolutely. Anish, how important is, as you were sort of engineering that turnaround at M&M and that ROE target, etc., how important do you think is the external environment? Because, I mean, after COVID, generally consumption got a bit of a tailwind, right? I mean, especially at the premium end. Do you think that also helped, and to what degree? What you did, of course, was absolutely critical. So tailwind without the engineering in the company would not have worked. But how much would you attribute to, I mean, you know, tailwind from the outside world?
So if you look at the facts here, there were two large factors that drove the turnaround. One is exiting loss-making businesses which had nothing to do with the environment. And second is the pivot to growth. And in the pivot to growth, the auto industry has grown single digits over the last few years. But it's really been the strength of our products, and we've tripled capacity and still haven't been able to meet demand. Similarly, the tractor industry has grown on average low single digits, except for 1 year, the COVID year was a strong year. But our tractor business has managed to gain share in a tough market as well. And then other businesses have grown from low bases in some cases, or a turnaround in both Mahindra Finance and Tech Mahindra from larger bases as well. So the external factor helped in the sense that it wasn't negative, but I think a lot of the growth was driven by a different approach that was taken by our teams to be able to get on a faster path of recovery and then go beyond that.
I mean, the product introductions, etc., right? I mean, you had to meet the market and what it wanted. So you had to do that from the company side. Mr. Gupta, you want to just sort of come in there as well? I mean, the outside environment, and again, is that example of Jio, and when they came in, how much was, of course, you strengthened the balance sheet and you made sure the three things that you spoke about, but is that a big factor as well in your opinion? I mean, that the external environment eased out a little bit.
Well, ours was a strange industry because COVID really helped our industry. We had some of the best demand scenario for our industry during COVID. The work from home, all that added. So we were never had a great loss on that account. But yeah, external factors do make a difference. But I think if your industry is solid, you have to just keep the course.
Got that. Amit, the next question: how much to buy from an investor?
That is where I think Rakesh used to make a huge difference. I mean, you get an idea 2,500 share खरीद लो. He was not like that. He would buy 10% of his, 10% of the company itself, because he had, but he had a huge appetite. I think that is what really, when this kind of opportunity, because these kind of opportunities, I mean, opportunities come 30, 40 in a year, but you to understand and get convinced about, there are very few. And when you get that opportunity, and if you buy a marginal position, it's a wasted effort. Better don't bother about it. So,
I've never seen him put marginal money in these kind of turnarounds. He's always put very serious money. Relative to his portfolio, see, if you look at his journey from maybe 2000 or maybe earlier to date, whatever, maybe before I knew him and since 2000, since I knew him, relative to his portfolio, he always made outsized bets. So if his portfolio was 1,000, like if it was 100 crores, he would be making 10 crore bets. If it was 1,000 crores, he was making 100 plus crore bets. When it became a 5,000 crore portfolio, he was making a 250, 300. So his bet size kept increasing. And I've seen cases where he bought more than the promoter owned there. So it's like, we've seen, like, I don't know how. So even before that, Raamdeo ji, bet size is important, but even before that, the courage to buy is more important. See, when you are faced with that kind of a situation, all the rules you placed, you said you buy, but you never said courage to buy. Right? If you take that example of Indian hotels which he bought, in peak COVID, when all the hotels are shut down or they're being used as COVID centers, to suddenly go and buy 2% of Indian hotels, thinking that once COVID goes, things will get better, you need a different kind of courage. You need ice in your veins to be able to execute that.
yeah. So very difficult it is for me.
So after that, it's like, yeah, so, and if you ever come across, these are rare opportunities, so you should put in serious money behind it. Because it's going to be very painful.
No, absolutely. And Raamdeo ji, you were saying in the presentation that if you buy, आपने बोला 2,500 शेयर अगर ले ले कुछ कोई फायदा नहीं है. तो आप this what you found in your study, does it, now you have the framework. Now you cannot say you don't have the framework when such opportunities come in the future. You said you don't have the framework. Does the framework and the sort of back testing give you the confidence that you should go in and go in big when opportunities like this arise? And
Yeah, sure. Let the opportunity come, no? And let my bulb also, kind of work in the sense that I should be convinced that I wish Rakesh was here and to teach me this strategy. But since he's not there, Amit is the best guy. But, getting that conviction that there is no downside. What this study brings out is that there is no downside. From the point of maximum pessimism, there is no downside or very marginal. So that I can bear. And now my net worth is such that I can think about having a 500 crores, 1,000 crores position. At least technically I can have that position. But will I be able to execute? I mean, it's a point of time. Because right now there's too much optimism around. So we have to find the stock in a pessimistic environment, and it should be no-brainer. One of my friends talks about stocks which are no-brainers. I think Rakesh used to buy at a situation when it is no-brainer. So if it comes, obviously this time I'll be more aggressive, I hope.
Mr. Gupta, you want to comment? You've been listening keenly.
The fact remains, in retrospect, everything looks like a no-brainer. But at that particular point of time, telecom is a classic case. In 2001 in particular, when we were very small, we didn't have resources. The question was not whether we will fail. The only question on everybody's mind at that point was when. So it was not whether. It was given that we will fold up, we'll go. So it does look like a no-brainer. We were a good player at that time also. We had just got listed. Stock had fallen from 45 to 19. Nobody was ready to touch our stock. So these things, I think sometimes in retrospect, do look like no-brainers. But at that point of time, they look very dangerous. And I guess that's where part which nobody has talked about till now. Some vision plus luck would certainly be playing a role. I don't know. Raamdeo will be the best one to tell us about it.
No, I think luck also comes from prepared mind. If I don't have the framework, what kind of preparation I have?
That I agree.
So it is very important that you have the framework. I think the biggest contribution of this study is that it very clearly lays out rules of the game. Now, how well you play is your courage, your luck, and your research team. You know, like Amit kind of guy. I mean, the way they research is very different from the way my sales side works. I mean, these guys are dedicated. I mean, they will have lunch, dinner. They'll literally camp with them. They'll go to the factory. They'll drink with them, sleep. so, so these guys, they don't spare anything. They literally know. I mean, there is a little difference between their analysis and what do you call, uh, leave it. So,
You
so
know,
that's,
so let's talk about the, so there are bruised blue chips, but are there also broken blue chips? Are there mistakes to avoid here as well? So while you
course.
laid out the framework,
No, of course. I think it has, because there are not many broken blue chips, you know. So there is a difference between bruised blue chips and broken blue chips. So sometimes because of the regulatory framework or completely a company which is by chance goes into, say, some kind of embezzlement, complete corporate swindling, you know, so then the companies don't get bruised and they come back. The company is finished. Like, say, one of the corporate misgovernance, I would say, I mean, it's a very harsh word to say for any company, nobody likes it, but say CG Power. I mean, it's a brilliant blue chip company. I mean, leader in their own field, transformer, switchgear and all that. And then they literally went through the bankruptcy because of complete misgovernance financially as well as in all aspects of it. And from there, when you see the change of the government, sorry, management, from a completely mismanaged to most brilliant guy to come in, Velayan and Murugappa Group, most ethical, most competent to handle. And then on top of it, turnaround happens and then tailwind comes. So
Yeah.
it's like a complete exponential from 5, 6 bucks. The stock is now more than a lakh crore and stock is 700, 800 rupees.
and 1,000 crores in net profit last year. So
And there is, the capex cycle just about started.
absolutely.
So they'll go for the kill.
Amit, you want to add anything to this in terms of mistakes to avoid while we talk about all the opportunities in the upside?
Mistakes to avoid when looking for these stocks, or mistakes to avoid when which leads to a stock becoming like this. Yeah.
Mistakes to avoid when looking for opportunities in this area. I mean,
It has to be a very deliberate decision. Yeah. It cannot, your portfolio cannot be contrarian or consisting of this only, but this happens once in a while. So you cannot say, I'm going to be constructing a portfolio consisting only of these kind of stocks. Yeah. So if you think that every stock you can pick up, you are a contrarian and you can make then you are going to be in trouble. Yeah. These kind of opportunities don't come often. Yeah. That can be the biggest mistake. And having a closed mind. Like for example's sake, like in telco, twice he had gone wrong, Tata Motors, and still he put money third time. So you have to have a very open mind also.
Anish, just to sort of wind this down, what is your experience being when dealing with investors, speaking with them, and how's that journey evolved in terms of managing expectations and sort of taking them along, but at the same time also, of course, you have to do what you have to do for the company, and then the market does what it does.
So we have valued the input from many of our investors and we interact with them on a very regular basis. From everything I've seen, it's important to have a very clear approach that we outline and then be able to deliver on what we've said. Yes, there may be some times when things may not go exactly right, but then we've got to be able to stand up and say, yes, this did not go well, we did not execute well here, here's a lesson from this, and then we go back and fix it and move forward. Because everything's not always going to go 100% right, but taking ownership for that is important. So essentially, it's a clear strategy, deliver what we commit, and take ownership for things that haven't worked well and fix them. And that's worked well for us.
Mr. Gupta, last word to you on that front.
Well, on the investor front, we were one of the first companies when we got listed in 2002 to say we will not give a guidance. Those were the times when it was not only fashion, it wasn't fashionable, it was kind of mandatory to give guidance. And we did not want to put undue pressure on ourselves or our execution teams to chase the tail because things change, strategies change, the way of delivering that changes. So we never gave guidance, but what we believed was be extremely transparent, not for the investor, but for our own teams. The more transparent we were, the more we could see the mistakes which we were making, the more feedback we got, and that really helped us in correcting the course whenever something was going wrong. So investor feedback can be very good, but to just go with what the investors would be wanting may also not be a great policy for a corporate. One cannot, as a corporate, to my mind, get obsessed with share price. One should not.
No, that's very well put. Let's wind this down. We have the best of the stock pickers here. Raamdeo ji, you already told us Asian Paints. आपने बोला जब bulb जलेगा तो
अरे ऐसा मैं कुछ नहीं बोला भाई. So, this is, see, if you see that 11 companies we have put in the report, all kinds of companies are there. And
but
they're
don't
getting,
limit yourself to the 11 companies. I mean,
no, right now the data says that more than 30% decline in the price from all-time high. There are 11 companies and they are blue chips.
correct.
Now, first it has to fall 50%.
Okay.
It has not fallen.
Okay.
And I don't wish them to fall that much. So don't misunderstand. If, see, the opportunities come walking to you. There will be so much of pessimism, there will be so much of corporate war, profit war,
Right.
that it might throw opportunity. Because right now markets are in bullish condition.
Correct.
The valuations are 10 book, 20, except for IOC. But I don't like that segment that much. But IOC is about 1.1 book, and it's fallen by whatever, crazy number. So I think that is one stock. And when you're saying IOC, obviously HPPP also comes with that. So clearly that is one segment to watch. Now what happens to the oil price? By chance oil price comes down from, all the chartists they say that it is going to come down to 50. If by chance that were to happen, you'll see story developing out there. So I think, but I don't have anything live where I can put a finger on.
But the watch list is ready.
Watch list is ready. Always it will be ready.
Amit?
Repeat your question.
Sorry?
No, what are you asking? Like,
Anything on your radar right now, which has fallen enough, which looks like a,
oh, you want a particular stock?
I mean, one or two or three, up to you.
No, I've got nothing like that to.
Nothing?
Maybe Anish has some.
Yeah. Yeah.
I was going to say M&M, but I cannot say that, so I should just...
Go ahead, America.
Let me ask one question about M&M. See, now one of the biggest transition is going to be from IC to electric. You are basically an IC company right now. And I think you are on the verge of launching one of the biggest, a good portfolio of electric vehicles. How do you see next 5, 10 years, at what pace this transition is going to happen? Because when I was driving electric vehicle, I think the BYD vehicle was amazing, the kind of pull and the noise-free, the saying. So future definitely belongs to electric. And I think you also believe in that. So how exactly this is going to transit for you? Is it disruptive? Tesla and all are going to come? Or you have a game plan ready for that? And mint money in electric era also.
So I will start again with facts. We've recently launched 2 born electric vehicles. These are on a made for electric platform, and the reception so far, while we haven't opened bookings as yet, is very, very strong. We've seen 1.3 billion views on social media for the vehicles, and I would let the product speak for themselves. So as they come into the marketplace, we feel very confident that they will match the best in the world in terms of quality. And that's going to drive the transition to EVs, because as consumers see products that they love, and products that take care of all the range anxiety that used to be there earlier, because the rated range in these 2 products is going to be 682 and 656 kilometers. And the actual range on roads that we've tested over the last 6 months across 21 cities is greater than 500 kilometers in every single city. So you're going to really take care of all the range issues. And what we expect is that 30% of our portfolio will be electric in terms of new sales in the next 3 to 4 years. And that's going to really help jumpstart the transition to electric from the country standpoint.
How much of the IC world, in the sense that all the four-wheelers, how much of that you see in next 5, 6 years to be electric? in practical way? How much transition can happen?
I don't think the transition is going to happen that fast overall in terms of everything moving to EV, because with the growth in the market, our forecast is we will be making the same amount of ICE vehicles we make today, even 5 years later. But that's because we're going to grow in electric as well. Because there will be still some applications for 4x4s off-road vehicles where you need the torque that diesel provides. And in some sense, we will see that transition, but it's not going to happen overnight.
You know, for both Mahindra and Bharti, there is one common, I don't want to say threat, but Mr. Musk. There is his Tesla, there is his Starlink, and both are waiting to make an entry into the country. Is that, are we going to see cheaper Teslas? You know, much lower import. Is it possible? And how does that play in the marketplace?
So we have benefited significantly from competition over the last 25 years. The kind of vehicles we make today, we would not have made if it hadn't been for strong competition. And from that standpoint, we would welcome Tesla or anyone else to come in as well. And as I said earlier, we will let our products speak for themselves.
Mr. Gupta, I mean, Starlink, does it really go head to head in terms of competition with incumbent telecom players, or is it largely for, as they say, dead zones? I mean, the satellite service in terms of what Starlink offers, or does it have really commercial use in terms of what you offer? Go on.
No, it can be. I think with direct to device coming, if you roll up 10, 15, 20 years, 10 years maybe, enough capacity, it can be. And I think all sensible companies, to my mind, must always be threatened by something or the other to be on their toes. As far as Mr. Musk and Starlink is concerned, I think they're doing a great job. Definitely, they are becoming a threat to the developed world telcos. Now, why I say that is it's a matter of pricing. In India, a GB costs 13 US cents. In US, it costs $5 to $6. He's already at that price. And therefore, in a world which is used to $50, $60 ARPU for 6 or 7 or 8 GB of data, I think it's already a threat. But India, in some ways, very defensive story. They are so cheap that it will be a long time before it becomes a threat. And by that time, the cost of reducing a GB on terrestrial networks will further come down because the capacity which will be available on 60, which would come later, will be phenomenal. So, yes, I think quite safe. But yeah, this is certainly a threat. It should be watched very carefully.
Got that. I think we've come to an end of our discussion here. Mr. Gupta, Anish, thank you very much, both of you, for coming on. And I'm sure with the businesses you've built, with the leadership position that you have, both of you will, of course, you know, weather any challenge which comes your way and continue to grow and create wealth for investors. Thank you very much, Mr. Gupta and Anish. Amit, thank you so much for candidly sharing all those experiences with the viewers here. It's been a real pleasure. Thank you very much. And Raamdeo ji, thank you for being a teacher more than anything else with your wealth creation studies. We really enjoy it, look forward to it. I certainly learn a lot from it.
Yeah, thanks very much to all the people who have come here. And very special thanks to Anish and Akhil for sparing their, from busy schedule to come here and talk to the investors about their experiences. Thank you very much.
Thank you.
Thanks, Prashant, for moderating such an insightful and engaging discussion. I think Dr. Anish Shah has to leave for another engagement, so we'll felicitate the panelists first, and then we'll do some audience Q&A. Rohini, so Raamdeo ji can do the... Yeah. Thank you, sir. Yeah, thank you very much, gentlemen. I think Dr. Anisha has to leave for an engagement, but Amit and Prashant can be here with us for the Q&A, audience Q&A. I'm sure there are a lot of questions out there. How long? 10 minutes? Okay. Audience Q&A. So we'll do the audience Q&A for 10 minutes. I'm sure there are mics around. So if you put your hands up, we'll get a mic to you and you can ask your questions to the panelists. Yeah, I think we have a mic here. We have a mic there. Whoever wants to ask a question. Yeah, we have a hand up there. You can.
Hello.
Yeah, Mr. Gupta, thank you very much for your presence. That
Thank you.
concludes the panel discussion. We are grateful
Thank
for
you.
your insights.
Thank you very much. Thank you.
Yeah, please go ahead.
Hello.
And
Yeah.
please tell us whom you're addressing the
Thank you
question
so
to.
much, Mr. Raamdeo sir, for this delightful, well-studied report that you have created for us. My question is for you. As we enter into the stock market, when we enter, it is equally, important to exit at a particular interval. So standing at this point of time when the markets are so volatile, can we have some kind of, sectors or some kind of stocks which you would suggest we should not, hold for the coming period? So that was my question.
I think exiting.
Sorry, you were asking
To
kind
just
of stocks
simplify
we should
it,
avoid.
it's equally important to exit at particular interval into some kind of sectors or some kind of stocks. So is there some kind of sector or stocks in your mind which you would suggest that we should not, hold at this point of time, or we should try to avoid for the coming period?
Okay. Yeah, so actually the way I practice is that I never go in cash. So I'm 100% allocated, but I do churn the stocks I have. So it depends on what you have and with what thought process you had bought. So if it is successful, you made 10x, 5x, whatever, then you can think about finding a newer stock, which is kind of a new growth stock or new bruised blue chip, whatever you want to buy, you know. So you can churn within, but I would think that Indian markets have given this 15% compounded and that journey continues. So you stay within. You know, if you are a practitioner yourself, if you are a mutual fund buyer, in that case, in any case, the dirty job is done by the fund manager. You have to just keep holding the mutual fund units. So I would think that you stay on as far as the allocation is concerned, but the churning is completely your call.
Yeah, but some kind of sector or some stocks, if
I don't have any suggestions because now I don't actually buy sell stocks, which is done by more the fund managers.
correct. Yeah, thank you so much.
Yeah, I think there's one question there.
Hello. Hello.
Yes.
My question is to Raamdeo sir.
Yeah.
Sir, we see that the corporate earnings in presentation also. In this quarter, corporate earnings are down. So just I want to understand what is the reason behind that, or is it temporary, or is it something is happening in industry?
So corporate earnings in the past, like between 14 to 20, it was very stagnant. I mean, it grew at 5-6%. So we could be in a different kind of situation. But I thought when you look at the data from 2020 to 24, it has very comfortably grown at the rate of 17-18%. So 17-18% on 1,000 EPS for Nifty is tough to replicate. But going back to 12 to 15% in 25-26, now 24-25 is more or less done. First half is flat, 5-6%. Even Q3 looks to be pretty muted. Only in Q4, the bunching of the government expenditure, maybe we should see the revival of corporate earnings. There is no reason why it should not get revived. And now we have a change of governor also. Maybe we can get some help from him in terms of, because government is extremely committed, mind you, to grow at about 7, 7.5. So when it falls to 5.5 or even lower, uh, the, the babus, the bureaucrats, they come back with whatever it takes to push the growth to more like 7, 7.5%. So what they will do, how they will approach, what is going to be the macro strategies, monetary or fiscal, I have no idea. But I have great faith. They will come back in second half of this year and first half, particularly the first half of next year, which is the base. So I would think that next 3 quarters, starting from Jan, should be very good quarters. And if they don't revive in next 3, 4 quarters, then I think the problem is deeper and we have to figure out what is the problem.
Hello Raamdeo ji, my name is Yash Jain. I had one question for you and one question for Mr. Goela. To you, the question was, in your presentation, you did speak about the price correction to identify bruised factor of the blue chips. How important is the time correction, I want to understand, because the stock could be staying wherever it is, but the index moves up. That also means that it's corrected. So how important is the element of time correction? And to Mr. Goela, you spoke about the investing style of Mr.
Yeah, let's let
Yes.
Raamdeo ji answer, and
Sure.
then we can.
So, you know, as far as since I'm not a practitioner, and whatever time it takes for the correction to happen, what is more important is 60-70% correction. That qualifies for the proper bruising. And when it corrects 70%, you can see the conditions inside the company as well as the investors. And when actually the losses come, at that point of time, since you are not holding the stock, you are welcoming the damage. But the guys who are holding the stock, for them it's a nightmare. And then finally point of maximum pessimism comes, and it can happen very quickly if all three comes together, in the sense that internal problem, external problem, and the market also slumping. So it can be very swift, like what happened in COVID time. But some other time, like Bharti and all, they took a lot of time for it to hit the bottom, maybe 3, 4, 5 years. And I think even escorts took a lot of time, which Amit will tell you. So there can be all kinds of things, provided have they actually gone down by 70-75%, because that creates the asymmetricity. That 4x, I mean 25 going back to 100, that gives you 4x opportunity. Even if that happens in 3, 4, 5 years, you are going to make 20-25% for sure. So to my mind, what is more important is the depth of damage and then prospect for the future of the company. Not so much, I mean, I've not studied the time correction, but I don't think that really matters. You have? Yes.
Yeah, please go ahead and ask your question.
Yeah, same question.
To Mr. Goela, just one question. Raamdeo ji spoke about the person who's holding the stock. There are nightmares to the person when something like that happens. From Rakesh ji's style, what is the right way to assess, reassess your position and understand that your bet is not working and it's the right time to exit?
Very difficult to explain, yeah. No, see, once you have bought a stock, then you keep following the stock, keep looking at the numbers, keep seeing whether the thesis is coming true or not. But you have to give time, yeah. Nothing is going to happen in 6, 9, 12 months. Yeah. We have to, average holding in our system is almost of 9 years, yeah, if not longer. So time is the only thing, because time is the only edge you have. You have to give it time. Because in that also you will have slip-ups. It's not that after you bought every quarter will be good.
Sir, I have a question for Raamdeo ji. You mentioned the definition basically of the bruised stocks. 20% ROE last 10 years and 50% downside. Now, Asian Paints, if we take the example of Asian Paints, already they are getting the competition from Grasim. They are also coming out with a big unit. Berger Paints is there, others are also. So earlier it was a monopoly. They have lost the monopoly. So even after so much bruising, do you think it will come back to its prime again? Because there is, the monopoly status is gone now.
Yeah, so what is the guarantee that builders will be successful? See, how the situation opens up. Right now, see, there are 2, 3 problems. One is the competition. Second is the slowdown in the consumption, which is a bigger problem. I mean, it is not only the fight, it is also the slowdown in the consumption. So per se, industry is in bad shape. Now, if a big major group with a lot of money, they want to gain 10, 15, 20% so that they can be number 2 player in the market. You know, so that's going to be very painful for the existing guys to accommodate a new player with a 10, 15% market share, because that is, since the market is not growing, it is going to go from their own pie. And when that happens, obviously they will try to hold back the market share, because it's a fight for the market share. Market is not growing. So that is going to become painful. Now, how painful it becomes, only time will tell. And as becomes more painful, the loss in the stock will also increase. Because one is what is happening in the corporate boardroom or marketplace. And second is what is happening in the stock market. Whatever happens there will reflect here. So I think we have to keep watching till it crosses 50% decline. I don't wish them to be in that situation. But if by chance that happens, then we'll see what happens. You know, because the point is, once that challenger becomes an incumbent, once they get, say, 10%, 15% market share, then builders also want to make a lot of money. So then again party starts. But before the party starts, it will be very bad. I mean, there won't be anything. I mean, the industry profitability, which is one of the most brilliant in the last 10, 15 years, that can get damaged by 50, 60%. So I don't know what all will happen, but let the things develop. And the moment the party starts again, they will swiftly go back to wherever they started from. Because by that time, market size would have expanded by 50, 60%, or maybe it would have doubled.
Yeah, I appreciate that point. The market size must have appreciated by that time. But when some company like Grasim, Aditya Birla Group is coming in competition, will they be able to get back to the same level again?
Will there be?
Grasim, Aditya Birla Group, when they are going to come in competition, who are already seasoned players in the industry, not in this industry, but they are seasoned players. So will they be able to come back to the prime again when they were monopoly? Though the market share may increase.
Yeah. No, see, they are also coming to make money. They're not coming to just destroy Asian Paint or anything. They want to make as much money as much Asian Paint is making. Now only time will tell who makes that. I mean, who becomes number one. See, that is what exactly I was asking Anish. Once you see, today, builders' opportunity, builders' mandate is what? They want to set the foot in the industry successfully. So they would like to have maybe 5,000-6,000 crores turnover, EBITDA margin of 10%, 500 crores. So then they can, all of them, they can say that we have made successful entry. Then once they start winning, they are not going to stop anywhere. So how exactly the journey starts? And meanwhile, markets will start growing at 8-9%. So there is a market expansion, and there is a kind of a smooth entry of builders. And once that is done, then instead of 3-player game, it will become 4-player game. Or maybe there could be consolidation. What the builder did in cement, they had Indian Rayon, Grasim, and a whole lot of brands, you know. Then they bought Ultratech. And they merged all the brands into one, and they became Supreme Cement Company under the Ultratech. So this is a brand game. So what all will happen, we don't know. Let the condition be there. I don't have any forecasting ability of what is going to happen in the marketplace. I can only see if the company is bruised deeply. At that point of time, we'll assess whether there is an intrinsic value of the company is still safe. If the intrinsic value of the company is completely tarnished, we'll wait for even deeper correction.
We can now wind up the proceedings of the evening. Thank you very much to all the panelists. There is a wealth creation study report outside, so in case you haven't got your copy, you can collect it on the way out. Thank you very much for your presence.